Good morning. Hello everyone. Today I would like to share to you the easy way to understand the preparation of the financial statement or financial report. Okay, but before we started, we would like to know how far you understand about the financial accounting and management accounting. Because we can complete your financial statement if you don't know the process activities before start to provide the financial report or financial statement itself. So why you have to understand the final accounting and management accounting, even though we will learn about the financial statement. And I know most of you don't like the accounting matters because it's confusing, complicated, and completely not fun. Well, let's break the stones. Okay, now back to the question is what is your understanding about financial accounting and management accounting? Yes, please. Yeah, okay. Okay, thank you all. Some answers can be said quite understand, and some others still need further understanding. But no worries, that's why we all here will discuss it until you know better than before, of course. Okay, now actually we have to know four definitions. They are accounting, financial accounting, management accounting, and financial statement. And what comes to your mind when you think about the term accounting? Well, for most of the people, what generally strike is money, right? And how to account for such money. And accounting is one of the subject in the main commerce stream, which gives a detailed view of the movement of money. And accounting is very important practice since proper accounting of transaction can be helpful in understanding the future prospect, risks, and return on investments. And when accounting is done, reporting such a transaction is equally important. Okay, so now you can see the financial accounting versus management accounting. The key difference between financial accounting and management accounting is that accounting is the process of recording, maintaining, as well as reporting the financial affairs of the company, which shows the clear financial position of the company, whereas the management accounting is the management of the finances and investment of different individuals, organization, and others. And both financial accounting and management accounting are a part of the main accounting stream, and they are follow the same rules and the principles of accounting as well, and both are aimed to report numbers that will be used to will be used for the betterment of the future prospect. So to make it more clear, look at this table, and this is the difference of management accounting and financial accounting. So as you can see, okay, as you can see differences between financial and managerial accounting. So you can see at the financial accounting, the function, we have the function, six functions. As users in the part of financial accounting, this is for external persons who make financial decisions. And for the managerial accounting, managers who plan for control and organization. It means now we we go to the next definition of financial report or financial statements. Financial statement or financial report are formal records of the financial activities and position of a business, person, or other entity. Relevant financial information is presented in a structured manner and in a form which is easy to understand. They typically include four basic financial statements accompanied by a management discussion and their analysis. So the final statement consists five reports. They are income statement, balance sheet, statement of changes in equity, cash flow statement, and the note management discussion and analysis. Now, and today we just learned about the three fundamental financial statements, and they are balance sheet, income statement, and statement of changes in equity. Last week we already did discuss about the accounting cycle, but just because we don't have enough time at that moment, so we just talk about the flow process of financial report or financial statement in their process or accounting cycle. So you can see in this picture now, we learn more details of its process. Okay, let's refresh for the topic last week. This is the steps to make financial statements. So as you can see, this is the cycle. We have 7 steps. The first, analyze business transactions. Second, journal transactions. 3, ledger accounts. 4, trial balance. 5, adjusting entries. 6, adjusted trial balance. And 7, prepare financial statement. So watch how we prepare. The first, for analyze business transaction. First thing first, you have to set up the COA or chart of account, as you can see in this sample. Yeah, we have 19 accounts and we have a reference number. Okay, for example, number 1, account cash, and the reference number is 101, and the second, for office supplies account, the reference number is 102, and until number 19, gain and loss, reference number 600. Okay, so after we made the chart of account, so we can go to journalize. Actually, we already learned about how to make the journal transaction, and this sample has 12 transactions. Okay, you can see at this sample we have 12 transactions and so many transactions here. So we already put in debit and credit, so we don't have to learn more about how to put. Okay, next step, to make it easiest to prepare this financial report, of course we have to prepare the worksheet like this. Now maybe it's your turn to help me to explain this worksheet. Anyone? Okay, it's easy. Actually, all the numbers already grouped earlier. Well, okay, take a look to this worksheet. Look at 4 columns, the gray, yellow, blue, and pink. At the gray column, we just copy paste the chart of account that already made. So we got the account, for example, for cash and the cash reference reference number 101. Okay, and next at the yellow column, unadjusted trial balance. Actually, all the amount move from general ledger. For example, for cash account, we got 17.820 from general ledger balance. So we put to debit in an unadjusted trial balance in this worksheet. Okay, for example, again, office supplies, we got the balance 800 in debit. Okay, and so on. And we got the total unadjusted trial balance 37,250 and balance debit and credit. Okay, now go to the adjustment column. So remember, we just have 4 adjustments in this all the transactions. We got the office supplies with 500 in credit, and we put debit. Look at the below equipment expense 500 in debit. So this is balance. Next, for salary expense, we got adjustment in debit 2000, and then we put fee payable 2000 in credit, and so on. So until all the numbers balance. Okay, so for the total adjustment, we got 3,300. Next, for adjusted trial balance, these numbers you only put all the balance from an adjusted trial balance and adjustments, because we just have different number only 4 transaction in adjustment. So we just look at the adjustment transaction only, because for cash account 17.820 in debit, and we don't have adjustment for this cash. Of course, at the adjusted trial balance, still the same, 17.820 in debit. Okay, so go back to the unadjusted trial balance. For salary expense, 12,000. Salary expense has adjustment 2,000 in debit. Okay, unadjusted in debit, adjustment in debit as well. So adjusted trial balance become 12,000 plus 2,000, and the balance for 14,000. Okay. All right. So next, we got the sample different. Okay, for office supplies, in an adjusted trial balance 800, and in adjustment in credit 500. So the position unadjusted in debit and adjustment in credit. So this is a different position. Okay, so the next, in adjusted trial balance, we have to balance it 800 minus 500. So we got 300 in adjusted trial balance for office supplies. Okay, and so on. So we got 40.50 in the balance, adjusted trial balance. Okay, next, for the income statement and balance sheet, we discuss it after this, because I have to explain what is actually income statement and balance sheet. Okay, now we start to preparing financial statements. As I mentioned at the beginning, today we're going to prepare a set up basic business financial statements for a company during its first year of business. So we already see all the numbers put in worksheet. Now we have to provide the changes in equity statement together with the balance sheet and income statement. Okay, now we have the balance sheet. Now, what is the balance sheet? The balance sheet is actually one of three fundamental financial statements, and is the key to both financial modeling and accounting. The balance sheet displays the company's total assets and how these assets are financed through either debt or equity. It can also be referred to a statement of net worth or a statement of financial position. The balance sheet is based on the fundamental equation. It consists of three separate areas. There are assets, liability, and equity. So the formula like this: assets equal with the liability plus equity. If your company total assets do not match with the liability plus equity, then you've done something wrong. And this is the statement for the sample. Actually, this is I got this from that worksheet, the balance sheet here. Okay, as you can see, the three areas: assets, liability, and capital. Asset, we got the current asset, the total current asset 18.120, and the total fixed asset 4,750. So current asset, what is different with the current asset and the fixed asset? Current asset actually for asset within 1 year, and fixed asset asset with more than 1 year. Okay, so the total asset 22.870, and the liabilities 8,600, and the capital 14.270, and the total is the same with the total asset 22.870. Okay, now the income statement. An income statement is also known as the profit and loss statement, or the statement of revenue and expense. The income statement primarily focuses on the company's revenue and expenses during a particular period, of course. And this is the formula: profit equal revenue minus expenses and minus taxes. Okay, so we got the revenue 25,700 and the expenses total 15,880. Because the revenue bigger than expenses, of course we got the gain or profit, and the total of the gain 10,020. Okay, so this company got the profit actually. Now, statement of changes in equity. The statement explains the changes in a company's share capital, accumulated reserves, and return earnings over the reporting period. It breaks down changes in the owner's interest in the organization and typically include profit or losses from operation, dividend paid issue or redemption of shares, revaluation, and other item changed or credited to accumulated other comprehensive income. Okay, so the example like this, and formula: owner's equity equal assets minus liabilities. Okay, now we got the beginning balance 5,000 and net profits. We got net profit 10,020 and withdrawal by the owner 750. So we got the revenue 14,270. Okay, so the statement is explain the owner's equity shown on the. Okay, finally the financial statement already done, and I believe you know more better than before. And for today and every day, one thing you could do: don't be confused and hate about something that you don't know, because you just look at the big box with the bad cover. But try to find out what is inside the box and open it, so you will know the thing inside and you will know what you want to do with that thing. Alright, now we are finished the lesson today. Hope you will enjoy and more confident by understanding about the details of financial statement. And good luck in accounting course, and see you next week in another topic. Stay healthy, guys.